Your debit card gets declined at the pharmacy. You check your banking app and your available balance is zero. Then you see the dreaded hold message. Right now, in 2026, the IRS is actively freezing the bank accounts of thousands of retirees, legally locking them out of their own life savings. And in almost every case, it traces back to one very specific, highly misunderstood mistake made during a routine retirement withdrawal. Today, I am going to show you exactly what this trap is, why the new tax rules are accelerating these account freezes, and how you can protect your money before the government steps in. If you are over the age of 60, your retirement accounts are likely your primary lifeline. You have spent decades building this safety net. But what nobody tells you is that moving that money around, even just transferring it to a better bank or pulling out cash for a family emergency, I have seen people lose access to their grocery money, their mortgage payments, and their medical funds simply because they checked the wrong box on a withdrawal form. I am going to walk you through the exact mechanism the Internal Revenue Service uses to freeze your assets, which letters you absolutely cannot afford to ignore, and the single biggest withdrawal mistake causing these levies to skyrocket this year. I will also give you the exact steps to reverse a freeze if it ever happens to you or someone you love. This is information every retiree needs right now. So let us dive right into how this nightmare actually begins. The phrase IRS bank levy sounds like something that only happens to massive corporations or people actively hiding money in offshore accounts. But the reality is far more mundane and far more dangerous. A bank levy is an automated one-time seizure of funds in your checking, savings, or investment accounts to satisfy an unpaid tax debt. And I want to be perfectly clear about what happens the moment this triggers. The IRS does not send an agent to your door. They send a fax or an electronic notification, known as Form 668A, directly to your bank. By federal law, the second your bank's compliance department processes that form, your account is immediately frozen up to the amount you supposedly owe. If the IRS claims you owe $20,000 and you have $15,000 in your checking account, every single penny is locked. You cannot withdraw cash. Your automatic bill pays for your electricity, your water, and your Medicare premiums will bounce. Your checks will be returned for insufficient funds. You are effectively cut off from the modern economy in an instant. But here is the critical detail that most people do not know. When the bank does not send it to the Treasury right away. Under the Internal Revenue Code, there is a mandatory 21-day holding period. The clock starts ticking the exact minute your funds are frozen. During these 21 days, your money is sitting in a state of financial purgatory. It has not been permanently surrendered yet, but you cannot touch it either. This 3-week window is your one and only chance to negotiate a release. If you do not successfully resolve the issue by day 21, the bank legally must wire your life savings to the government, and getting it back after that is a bureaucratic nightmare that can take months, if not years. So how does a law-abiding senior citizen suddenly find themselves on the receiving end of a draconian tax levy? It all starts with the communication gap. The IRS will never freeze your account without warning you first. But the way they warn you is exactly why so many people get caught off guard. You see, the IRS communicates exclusively through the United States Postal Service. They will not call you. They will not text you. They will not send you a direct message on social media. But right now, retirees are being absolutely bombarded by sophisticated scams. You receive aggressive phone calls claiming you will be arrested for tax fraud. You get emails demanding immediate payment in gift cards. You get text messages with links to fake government portals. Because these scams are so prevalent, many seniors have rightly learned to be highly skeptical of anyone claiming to be the IRS. However, this perfectly healthy skepticism has created a dangerous blind spot. When the real IRS notices arrive in the mailbox, they are often dismissed as just another scam, or they are lost in a pile of junk mail. The escalation process is systematic. First comes the CP2000 notice, which politely informs you that the income reported on your tax return does not match what the financial institutions reported. If you ignore that, you will eventually receive a CP 504 notice, which is the notice of intent to levy. But the final, most critical warning is the LT11, or Letter 1058. This is the final notice of intent to levy and notice of your right to a hearing. It always arrives via certified mail. If you sign for a certified letter from the Department of the Treasury, you must open it immediately. Once that letter is delivered, you have exactly 30 days to file an appeal or pay the supposed balance. If day 31 arrives and you have done nothing, the IRS automated collection system generates the bank levy, and your accounts are frozen. The tragedy is that the underlying tax debt that triggers this entire catastrophic chain of events is rarely intentional tax evasion. In the vast majority of senior bank freezes, the debt is completely artificial, created by one specific, easily avoidable mistake made months or even years prior. And that brings us to the core issue. The single biggest withdrawal mistake causing these automated tax bombs is something called the Indirect Rollover Trap. Let me explain exactly how this happens so you can avoid it. Imagine you are 70 years old and you decide you want to move your retirement savings from an old 401k provider to a local bank or a new brokerage firm where you have better investment options or lower fees. You call up the old 401k company and tell them you want to close the account and move the money. The representative on the phone says, "No problem, we will cut you a check." You receive a check in the mail, you walk down to your new bank, and you deposit it into your new individual retirement account. You think you just successfully transferred your money. You think it is a non-taxable event because the money went from one retirement account to another. But you have just stepped directly into a financial landmine. When you take physical possession of a retirement check, rather than having the financial institutions transfer the money directly to each other behind the scenes, you are performing what the IRS calls an indirect rollover. Under federal law, if you do an indirect rollover from an employer-sponsored plan like a 401k, the plan administrator is legally required to automatically withhold 20% of your money for federal taxes. Let us look at the math, because the math is where the trap snaps shut. Let us say you have $100,000 in your 401k. You ask for a check to move it to your new IRA. The company only sends you a check for $80,000 because they sent $20,000 directly to the IRS for tax withholding. You take that $80,000 check and deposit it into your new IRA. Here is the catch that ruins lives. The IRS gives you exactly 60 days to complete a rollover to keep its tax-deferred status. But to complete the rollover, you must deposit the entire original amount of $100,000 into the new account. Since you only received $80,000, you have to magically come up with the missing $20,000 out of your own pocket to make the new account whole. If you do not pull $20,000 from your savings and deposit it into the new IRA within those 60 days, the IRS considers that missing $20,000 to be an early permanent distribution. But it gets worse. Because you failed to roll over the full amount, the entire transaction is flagged by the IRS automated systems. If you do not report it perfectly on your tax return, the IRS computer matches the 1099-R form from your old broker against your tax return, assumes you cashed out the entire $100,000 to buy a boat, and slaps you with a massive income tax bill. You have no idea this happened. You file your taxes normally. Months later, the IRS sends the CP200 notice saying you owe $30,000 in back taxes and penalties. You throw it away thinking it is a scam. A year goes by, the certified final notice of intent to levy arrives. You ignore it, or you set it aside, meaning to call your accountant. 30 days later, you are at the grocery store, and your debit card is declined because the IRS has completely frozen your checking account to collect taxes on a withdrawal you never actually spent. The only way to avoid this specific nightmare is to completely eliminate the indirect rollover from your financial vocabulary. If you are moving retirement funds, you must explicitly demand what is called a direct trustee-to-trustee transfer. In a direct transfer, the check is never made payable to you. It is made payable directly to the new financial institution for the benefit of your specific account. For example, the check would say Fidelity Investments, FBO John Doe. When the transfer is direct, There is zero mandatory tax withholding, there is no 60-day ticking clock, and there is no automated mismatch on your tax return. The money simply glides safely from one vault to another, but financial companies often push indirect rollovers because it is easier for their call center employees to process. They click a button, mail you a check, and wash their hands of you. You must stand your ground and insist on a direct transfer. If they try to mail a check to your house, tell them absolutely not, unless the check is made out to the receiving bank. Now, the indirect rollover is the most common trap. But as we navigate through 2026, there is a second massive trigger causing senior account freezes, and this one is entirely due to recent changes in federal law. I am talking about required minimum distributions, or RMDs, and the chaos created by the SSR 2.0 Act. For decades, the rule was simple. When you turned 70 and a half, the government forced you to start taking a certain percentage out of your retirement accounts every year and pay taxes on it. But Congress recently decided to change the starting age. They changed it to age 72, and then, for those turning 73, they pushed it 73. And eventually, it will push to age 75. This constant shifting of the goalposts has created a wave of massive confusion. Let us be clear about what happens if you miss your required minimum distribution. Historically, the penalty for failing to take your RMD was a draconian 50% of the amount you were supposed to withdraw. Recently, that penalty was reduced to 25%, and in some cases 10% if corrected quickly. But here's the problem. A 25% penalty on a missed withdrawal can easily equate to thousands or even tens of thousands of dollars in instant tax debt. Let us say your accountant miscalculates your RMD because of the new age brackets, or you simply forget to take it from an old, forgotten IRA. The IRS computers are incredibly efficient at tracking this. They know exactly how much money is in your traditional IRAs because your brokerage sends them Form 5498 every year. They know exactly how old you are if their system calculates that you were supposed to withdraw $20,000, and they do not see a 1099-R proving you took it. The computer automatically assesses a heavy penalty. Just like the rollover trap, this penalty becomes a sudden, unexpected tax liability. The automated notices start flying out of the IRS printing centers. Because the senior does not understand why they are getting a bill, they dispute it poorly or ignored it entirely. The debt ages, the automated collection system takes over, and suddenly the bank account is frozen. What makes the RMD issue particularly insidious is that many seniors have multiple retirement accounts scattered across different brokerage firms. You might take your full required distribution out of your Vanguard account, but you completely forgot about a small IRA sitting at a local credit union. The IRS looks at the aggregate total. If you fall short by even a few $100s, the penalty triggers, the notices generate, and the path to a bank levy begins. To protect yourself, you must consolidate your retirement accounts. The fewer accounts you have, the harder it is to make a calculation error, and the easier it is to satisfy your required distributions without triggering a fatal audit flag. So, what happens if the worst-case scenario becomes your reality? What happens if you are watching this video or sharing it with a family member, and the bank account has already been frozen? How do you fight back against a government agency that has the power to take your money without taking you to court? This brings us to the absolute most important part of this discussion, the rescue plan. Remember, that 21-day holding period I mentioned at the very beginning, that is your battlefield. When your account is levied, the bank freezes the funds, but they hold them for exactly 21 days before remitting the money to the United States Treasury. During this window, you must take immediate aggressive action. The first step is to never yell at the bank teller. The bank has no choice. Under the internal tax codes, if the bank refuses to freeze your account, the bank itself becomes liable for your tax debt, plus additional penalties. Your local branch manager cannot help you. Your fight is exclusively with the IRS. You need to immediately contact the IRS using the phone number listed on the notice of levy, or ideally, you need to hire an enrolled agent or a tax attorney to make this call on your behalf. When you get the IRS on the phone, your primary objective is to prove economic hardship. The IRS is legally prohibited from leaving you destitute. If the levy prevents you from paying for basic, reasonable living expenses like rent, mortgage, food, and necessary medical care, the IRS must release the levy. But they will not just take your word for it. You have to prove it. This requires submitting Form 433F, which is a collection information statement. You will need to provide copies of your utility bills, your lease agreement, your prescription costs, and your bank statements. You have to demonstrate that without the money in that frozen account, you will not be able to survive the month. If the hardship is approved, the IRS will issue a release of levy known as Form 668D directly to your bank. The bank will unfreeze your account, and you will have access to your funds again. However, a release of levy does not mean the tax debt disappears. It just means the IRS will stop holding your bank account hostage while you figure out how to resolve the underlying issue. This is where you address the root cause, like that indirect rollover mistake or the missed RMD. You might need to file an amended tax return. You might need to set up a monthly installment agreement. Or if the debt is completely accurate but you truly cannot ever afford to pay it, your representative can apply for an offer in compromise or ask to be placed in currently not collectible status. Another crucial defense mechanism is checking for a wrongful levy. Sometimes the IRS freezes a joint account where the tax debt belongs to only one person. For example, if you are an elderly parent and you added your adult child to your checking account just to help you write checks, the IRS might accidentally levy that account to pay for your child's unpaid taxes. In this scenario, you must immediately contact the IRS and provide proof that the money in the account is entirely yours, derived from your Social Security and your pension, and that your child is merely a signatory. If you can prove the funds do not belong to the person who owes the taxes, the IRS must release the freeze. We are currently seeing unprecedented levels of IRS enforcement. With the recent funding increases for the agency, their computer systems are faster, more integrated, and more aggressive than ever before. In the past, a taxpayer might have ignored a tax notice for years before a human revenue officer finally got around to issuing a levy. Today, the process is entirely automated. The computers detect the mismatch, the computers print the warning letters, and the computers send the electronic freeze order to your bank. There is no human compassion in the algorithm. It is a cold, mechanical process designed to extract revenue by any legal means necessary. This is why your financial hygiene must be flawless. You cannot afford to leave mail unopened. You cannot afford to attempt complex financial maneuvers like indirect rollovers without professional guidance. And you absolutely cannot afford to assume that the IRS will overlook a small mistake on your retirement withdrawals. Let us talk about the psychological toll this takes, because it is something rarely discussed in financial seminars. When a senior citizen discovers their bank account is frozen, the initial reaction is almost always sheer panic, followed by profound shame. People who have worked hard their entire lives, paid their taxes, and played by the rules suddenly feel like criminals. They hesitate to tell their children. They hesitate to ask for help. They sit in silence, staring at a zero balance, hoping it is just a computer glitch that will fix itself. I am telling you right now, it will never fix itself. The IRS automated collection system does not sleep, it does not forget, and it does not offer grace periods outside of the statutory limits. If you sit in silence on day 22, your money will be permanently transferred to the Treasury. Once the money is remitted, getting it refunded requires filing a wrongful levy claim or proving extreme procedural errors, a process that can drag on for up to 2 years. 2 years is an eternity when you need that money to buy insulin today. Furthermore, you must understand that a bank levy is not necessarily a one-time event. The IRS can issue multiple levies. If your bank account had $10,000 in it, but the IRS claims you owe $30,000, they will take the $10,000. They will take the $10,000 10. A few months later, if they see you have accumulated more funds, they will issue another Form 668A and freeze your account all over again. They can also issue a continuous wage garnishment against your pension or your Social Security benefits. Yes, the IRS has the legal authority to seize a portion of your Social Security checks through the automated collection system to satisfy a delinquent tax debt. To build an impenetrable fortress around your retirement savings, you must become proactive. First, open every piece of mail you receive, even if it looks like junk. If it has a government seal, read it. If it says CP2, 000, CP504, or LT11, treat it like a financial heart attack and seek immediate professional help. Second, audit your own retirement accounts. How many old 401ks do you have floating around from previous employers? How many small IRAs did you open over the decades? Consolidate them. Roll them over using direct institution-to-institution transfers. Never let a financial advisor or a customer service representative hand you a check made out to your name. Third, if you are approaching your required minimum distribution age, sit down with a certified public accountant. Do not rely on an online calculator to figure out your RMD. The laws have shifted multiple times over the last few years, and the S-Assure 2.0 Act has introduced further phase-ins for 2026 and beyond. A CPA will calculate the exact amount you need to withdraw and ensure the proper taxes are withheld at the source, preventing any automated penalty flags. Fourth, if you ever receive a tax bill that you know is mathematically incorrect, perhaps because of that indirect rollover trap we discussed, do not just ignore it. You must file a formal dispute. You or your representative should file Form 12153, which is a request for a collection due process or equivalent hearing. Filing this form within 30 days of receiving a final notice of intent to levy acts as a legal stop sign. It forces the IRS to halt all levy actions and transfers your case from the automated computer system to a human settlement officer. This gives you the breathing room to provide your bank statements, explain the rollover mistake, and correct the tax record before a single dime is ever frozen. Knowledge is your only shield against an automated bureaucracy. The IRS is not a malicious entity out to ruin your life. It is simply a massive, understaffed, heavily automated debt collection machine executing a rigid set of instructions. When you make a mistake on a withdrawal, you feed incorrect data into that machine, and the machine responds exactly how it was programmed to respond, by securing the government's money first and asking questions later. As we move deeper into 2026, the margin for error is shrinking. Paper checks are being phased out, direct deposits are subject to new strict verification rules, and the IRS is utilizing sophisticated systems to flag tax return discrepancies faster than any human auditor ever could. You have to adapt to this new environment. You have to treat every movement of your retirement funds with the precision of a surgeon. Let us quickly recap the critical takeaways to ensure you and your money remain safe. First, if you are moving retirement funds, never accept a check made out to yourself. Always demand a direct trustee-to-trustee transfer to avoid the deadly 60-day indirect rollover trap and the mandatory 20% tax withholding. Second, pay absolute attention to your required minimum distributions. Consolidate your accounts to make the math easier and work with a professional to ensure you withdraw the exact correct amount, avoiding the massive penalty taxes that trigger automated IRS collection actions. Third, never ignore a letter from the IRS, especially notices CP504 or LT11. Treat them with extreme urgency. And finally, if your bank account is ever frozen, remember you have exactly 21 days to act. Contact a tax professional immediately to prove economic hardship or file a collection due process appeal before the funds are permanently surrendered. The rules surrounding retirement and taxes are changing faster than ever, and real people are getting caught in the crossfire. I want to hear from you. Have you or someone you know ever had to deal with an unexpected IRS tax bill, an account freeze, or a nightmare scenario with a retirement rollover? Please comment your experience below. Your story could be the exact warning someone else needs to hear to avoid making a devastating mistake. Share this information with your family and your friends. Stay vigilant with your finances and protect the retirement you worked so hard to build.